Hi everyone. Good afternoon. So our panel is understanding ESG scoring and rating. It's really a topic that is very dear to my heart and my academic research and advisory focus. It's probably fair to say that the use of ESG ratings and data products has grown considerably in response to mounting interest in investing in companies that take into account sustainability in the way they run their business. And I think as a result, we've seen that the role and influence of providers of ESG ratings and data products in financial markets generally and the sustainable finance ecosystem, more specifically, has grown significantly. I think the timing of this panel is great because the IOSCO just 2 days ago published their findings around a review of ESG data providers. And maybe let's delve right into it with my fellow panelists. Michelle, before we delve deeper into the ESG ratings and data, what do you see as a data provider as the main drivers for the increase in sustainable investment and more generally the focus on ESG, Michelle?
Thank you, Lapman. So I work with Refinitiv, part of the London Stock Exchange Group, and we see many drivers for the increase in sustainable investing. But I think there are a couple that are more dominant than others, and I don't think they're going to be particularly surprising. But the first one, investor demand. So this one for me, I find really exciting and makes me very optimistic about the impact and the future state. So investor demand largely being correlated with that transfer of capital to the millennial generation who are demanding much more purpose-focused investments and are really putting their money where their mouths are, which is really exciting to witness and to see this groundswell that are moving the needle and insisting on ethical and sustainable investment choices. And we're also seeing very similar trends on the banking side, where the accumulated bond issuance in capital markets has exponentially increased over the last few years. And aligned to the individual investor demand, we're also seeing large asset owners now insisting and fundamentally acknowledging that ESG integration is a fiduciary duty of theirs and an obligation that is prominent in their strategy and investment mandates. And again, that is because their investors and members are demanding it. And then the other obvious driver that I wanted to quickly talk to is, unsurprisingly, the regulatory pressure, and that's been a theme obviously throughout today. And as we're very well aware, it's been lacking somewhat and inconsistent until now. We've had huge fragmentation in the way different geographies and sectors report and differing rates of adoptions, but it does feel like that is changing. And you mentioned the IOSCO report, and we've got governments and regulators now mandating ESG and sustainable reporting disclosures in a much more unified way. Frameworks are being introduced and aligned, and the announcements around the IFRS and the ISSB will hopefully further drive that adoption and consistency in reporting. So whether you're on the buy side and working through how to overlay portfolios with ESG risks, or you're a corporate trying to work out your own climate risk management strategy, or a bank trying to make sure your lending book is green, disclosure requirements and pushes to standardize and harmonize taxonomies across the industry is massive, and it's something we're really working hard to help our clients navigate. And the only other driver, which would normally be the start of a response to a question like this and be front of mind for investors, but tends to often be behind ethical considerations when talking about ESG, is performance. Ultimately, that ESG factor inclusion provides that optimum financial return, and the tide is turning even more now. Providing an overlay and reporting correctly and completely is now considered a risk from an investor perspective, and you'll certainly become a divestment target. So it's really exciting to see that balance shifting.
No, thanks for sharing that, Michelle. And Gabriel, any additional drivers that you're seeing for ESG investment?
From my side, I just completely agree with Michelle's comments, and the only thing I would throw in there as well is that I think there's also and it builds on the final comment, which is that for me, the increasing economic reality of socially responsible or ESG investments is starting to be a driver in itself. And we saw this through the initial stages of COVID, where companies with higher ESG performance showed more resilience through that period. What we also saw was that the Build Back Better programs around the world and the green capex that has been earmarked for a green recovery has led to a huge opportunity that's been recognised for renewable energy in other sectors as well. So for me, part of deteriorating cost curves around renewable energy and the increasing economic competition that some sustainable solutions can have, as well as all of the pieces mentioned around regulatory pressure, investor pressure, are really coming to a fantastically powerful confluence. So I just wanted to add that last point around the shifting economics.
Got it. No, thanks, Gabriel. Maybe I want to spend a little bit more time with yourself, because I understand you have spent a lot of time on the topic of ESG ratings at the likes of BNP Paribas, Goldman's, and now at Fidelity. Can you share with us what is actually an ESG rating, and probably can you compare with a credit rating, if that probably speaks more to the imagination for the audience?
Sure thing. And for me, this is something that I see compared a lot in the media, which is basically making the statement that credit ratings are typically the same. There's around a 0.99 correlation between the credit ratings for different issuers. Whereas if we look at ESG ratings, they're all over the place. And the correlation, depending on the academic study, is basically between 0.4 and 0.6 or 0.7. So you get a huge scattergun approach for some ratings. And in some instances, this is highlighted as proof that there's something fundamentally wrong with ESG ratings in that they're very different. From my side, I would actually be incredibly surprised if everyone's ESG rating was the same. And just to give a little bit of context on that, if we look at a credit rating, it's trying to measure the same thing. It's trying to measure the risk of default. It's using audited, well-established financial data, typically as the main inputs, and very established and back-tested metrics which have correlation or relationships to risk of default. If we sit there and switch to ESG data or ESG data providers and ratings, first up, they're not necessarily trying to measure the same thing. You can have ESG ratings that have more of a fundamental ESG integration bent, where it's trying to enhance alpha by picking risks or identifying some fundamental opportunities. There are others which tilt much more towards an approach of identifying the corporate governance structures or the contributions. And so there is actually quite a big difference between how a rating is actually trying to be structured, what they're trying to achieve. And then if we dig further below that, we also have the problem of data availability being a lot more scarce, lack of standardization, and very different methodologies around ESG ratings. Sometimes they're absolute, so you're trying to measure the absolute risk of default, or absolute risk of an ESG event occurring and causing value destruction. Other times it can be sector relative, so you're trying to pick the company with the best characteristics or worst characteristics relative to a peer group, and that can result in incredibly different outcomes using the same data and the same issuers. And so from my perspective, it's really about ESG scores being fit for purpose. And what we're increasingly seeing is a lot of asset managers, and Fidelity International included, starting to develop their own in-house ratings, where they take all the underlying raw data from other providers and then use that to fashion a score which is consistent with the way that they believe ESG should be integrated and can contribute positively, whether this is through fundamental issues or whether it's through identifying potential for impact and positive sustainability outcomes.
Thanks for sharing it. Good to know the difference and also the purpose of using credit versus ESG ratings. Let's see. Also, maybe given that I'm hearing a lot in the market different providers, and I know Refinitiv is also a provider for ESG ratings and data products. I mean, many of the companies I talk with, they talk about MSCI, Sustainalytics, ISS, Moody's, VKO IRIS. I mean, for what is actually your view, and any of you can answer, of course. So what are the differences between what they do? Any thoughts from anyone? I know Gabriel has done a lot of study around it, but any Eugène or Michel, any thoughts as well?
Oh, so from my perspective, okay. I think Eugène, you might be on mute. I can quickly talk from my perspective if that's of help, and then Eugène maybe come off mute. So obviously, from my perspective, I'm with Refinitiv, and we are one of I'm sure the best providers of ESG in the market. And as part of broader London Stock Exchange group, I think we see ourselves as a real connector within that financial community. So helping to drive that transition to a sustainable and low carbon economy, and to align to Paris benchmarks and support the transition. In terms of comparability, most providers collect information in very similar ways and publish it in very similar ways, but there are nuances, right? So we approach our responsibility as an ESG data provider really seriously. We understand that it's imperative to provide transparent, complete, accurate data, and to enable the correct sustainable investment choices to be made. So we look at things through a very quantitative lens. We don't offer opinions, but we provide full transparency around how the data is captured and reporting mechanisms, and that will hopefully enable end consumers of that data to really look at things through a multitude of lenses. And we apply things like materiality to differentiate companies in different industry and sector groupings, and I know others out there in the market do also. But we're also really conscious that company reporting is not always going to be a complete picture, and it's obviously curated for public and investor consumption. So it's the company's own view of their operations they're putting out into the world. So we also look to provide like controversy scoring overlays or sentiment analysis functionality, where you can use AI to scrape social media and news sites to establish if there are concerns with the company's operations or considerations that investors would be interested in. So there's I think that there's different ways to put the data out there. We do it in a very quantitative fashion, but there are other angles that other providers use as well.
Thanks for sharing. Also good to know that you're using FinTech, AI, machine learning for that purpose as well. Sorry, Eugène, you were on mute earlier.
Yeah, sorry. I mean, I think Gabriel made a point earlier about the diversity of ESG rating agencies together with ESG data providers. It is still an exploding field. And, if you think about the E, the S, and the G, there's three, chief categories that they'll fall under. But even within that, the categories of ratings that are issued and the uses to which they're put, either measuring, exposure to ESG risk or, sustainability impact, can be vast. And it's very important to understand, what is the purpose of that rating? What is it measuring? To what use should it be put? I think the other thing is, in terms of provision, as identified by Michelle, the two key drivers of regulation and investor demand, and even corporate and financial institution demand, is driving a very rapid evolution in the type of services that are offered. This is a bit like the sort of innovation at the beginning of the 20th century or the late 19th century, where you were thinking about, diversity of industrial production. The needs are evolving very rapidly. And indeed, there's very rapid evolution in the provider sort of ecology as well. Every time you turn around and do a market scan of who the providers are and what they're providing, there's been mass evolution, either in terms of the emergence of new providers or acquisitions and mergers. I mean, groups like exchanges and index providers are purchasing a lot of these entities. Entities such as ourselves are on the lookout for acquisitions. And even banks are making acquisitions in these areas as well. If you were to read about JP Morgan Asset Management recently and their acquisition of an entity called Myotech. So, it's almost, whatever you say in this field is almost outdated by the time you say it effectively, I think.
Got it. No, thanks for sharing that. I know, Gabriel, from our earlier coffee chats, we also talked about in detail the differences between the various providers. I mean, for the audience with the asset owners, the asset managers, the banks, what advice would you give them in terms of the choice of the provider based on what they are looking for?
I think it really comes back to one of Eugène's comments as well, which is that so much of this is about fit for purpose. And this comes back to the IOSCO recommendation around methodology, disclosure, and transparency, enabling investors to essentially pick a data provider which is going to be aligned with their own investment process, where they are in the world, where they invest, the asset classes they invest in, all of these sorts of things. And this is critical because there are so many inherent biases that get built into an ESG score purely by design. And some of these will be intended because they reflect the way you invest and the way that you operate, and they're deliberate decisions. But it's always a trade-off. And so from my perspective, it's critically important to be able to understand which trade-offs have been made and which decisions have been made from any underlying provider. And just as a really good example here is if I just take two that you mentioned of MSCI and Sustainalytics. If we look at, or even we can swap out MSCI for Refinitiv, and look at the difference between an absolute versus a relative scoring framework. If you have a sector relative scoring framework, it means that you're not penalized for picking individual sectors. So it separates a sector allocation decision from an ESG decision. Whereas if you take an absolute scoring methodology, it will essentially make it very hard to have a high overall portfolio score if you invest in sectors which have fundamentally higher risk profiles. And so you can have a little bit of a disconnect between what your investment strategy is and your ESG rating is actually providing or guiding you towards if you're not aware of those sorts of inbuilt challenges or inbuilt characteristics of the framework that you're adopting.
Got it. Now, I think that's good to understand that people need to find a company that is fit for purpose for themselves, and that you're not necessarily for harmonization of all the ESG rating, because that might defeat the purpose, I guess. Got it.
And just very, very quickly on that, because I get very emotional about that topic. For me, what I'd love to see, and what I think is fantastic with the International Sustainability Standard Board, is the push towards harmonization of the building block and the data. So there should be harmonization in the foundation, which I make an equivalent to you want companies to be reporting under the same financial regulations and accounting standards. But you wouldn't necessarily want to regulate that everyone has to have a buy recommendation on the same company at the same time. So what you do with that information can be very subjective. But I'm a big fan of the standardization of the underlying foundation and data.
Got it, for the underlying foundation. And maybe while we're talking about regulation, anyway, I'm moving to Eugène, given yourself as a former regulator of the SFC. I mean, Asia Pacific is obviously a complex and very diverse region. Can you share with the audience what are the APAC regulatory expectations? Yeah. I know some are still emerging.
Well, look, I mean, there's two dimensions to this. There's regulations of the users of ESG data and data providers and ratings agencies. Then there's regulation of the providers. Now, there's probably more of the former than the latter. Okay, so let's deal with the former first. There's an increasing amount of regulation in Asia in terms of risk management regulations and risk management framework regulations for financial intermediaries, banks in particular, asset managers, and to a degree insurers. And you see that across a few jurisdictions, certainly Hong Kong, Singapore, Malaysia's thinking about this, Japan's thinking about this, Australia's thinking about this, and the Philippines, interestingly, has a regime as well. So what does that say? That basically says assess your data needs to run those risk management systems, okay? Particularly recognizing that the state of data in APAC is probably less than what's desired, and I'll turn to that in a minute. The other thing is, understand the needs you have for data and what would be fit for purpose, to return to Gabriel's point. I mean, are the data and the ratings providers you're seeking to use right for the needs of your business, right for the needs of the particularly climate risk exposures that you're exposed to, because that's really the focus in Asia at the moment for regulation of financial institutions. To a degree, broader environmental risks, almost nothing said on social, and governance is sort of old hat, I guess. And then secondly, the capacity to understand these data providers and the ESG ratings agencies. And thirdly, the information systems to support them. Okay, so those needs analysis, and that capability analysis and that evolution in assessment is the critical thing from the end users of ESG data and ratings agencies. Now, on the other side, the regulation of the providers, not very much, I'm afraid. Okay, unlike credit rating agencies, which are a focus of regulation after the financial crisis, at present, there's little or no regulation of ESG data providers. Okay, what I would say is, let's focus on greenwashing for the moment, because that's probably the key area of liability in this area. Greenwashing is just fraud. Okay, there's regulation of fraud. securities law is based on concern about disclosure fraud. That's what it's all about since the 1930s with the setup of the SEC. So I would say under most jurisdictions in Asia, to the degree that they have provisions governing disclosures to investors or by listed companies, disclosures by ESG ratings providers and data providers, to the degree that feeds into those disclosures, is potentially liable for accessory fraud in relation to that. And in relation to the use of that information by asset managers or by financial institutions to market ESG-focused products, that as well would be the subject of fraud. So there's already, in the sense of like, don't tell lies, verify information, quite a lot of regulation. It's just not specifically focused upon ESG. Okay, the problems are proving materiality usually in relation to this, and also knowledge or intent as to whether it is knowingly false or mistakenly false, but you should have taken reasonable precautions to measure against it. Now, IOSCO did tepidly consider the issue of regulation of ESG data providers, and more particularly ratings agencies, and it sort of said, you should consider it, which seems mild, to put it loosely, I would say. And I say that being aware that EY itself, in some senses, could be an ESG ratings agency or data provider itself, and that we operate in the field of climate change assurance and sustainability assurance. We made submissions to the DFMA that we actually thought ESG ratings agencies should be regulated, but that's our personal view. Okay. So look, will regulation come of the ratings agencies themselves? Possibly. Certainly the UK FCA is quite close to considering that, and Her Majesty's Treasury in the United Kingdom. Within the European Union, they're also considering this issue. And the parallel to the issue of credit rating agencies is manifest, I think, although the purposes of those ratings are different. And as the point was made earlier, the uses of ESG ratings is far broader. Now, there is a diversity of opinion as well on whether regulation of rating agencies is necessary. Some would draw a distinction between the purpose to which it is put. Some would say that in particular where it's used in credit decisioning, purposes by financial institutions, particularly banks, that should be regulated, but perhaps not the use of it in terms of its use a bit akin to a securities ratings report. I'm not quite sure I buy that distinction, because if you think about securities analysts, they're heavily regulated, and the reasons for that going back to the early 2000s are manifest, I think. I think the conflicts of interest are lower in the ESG's ratings field because they're usually run on a subscription model rather than the issue of pays model. I think the issue of conflicts of interest for rating agencies is those who have blended functions where they provide consulting services and as well issue ratings over the entities that they might be providing ratings for, and that coaching them to improve their ratings and rating them is a self-evident conflict, I would say. Now, what's going to happen will be interesting. I mean, obviously, the regulatory community in Asia has yet to respond to the IOSCO consultation. The way IOSCO works is it makes recommendations, its members consider them, and that then gets fed into the domestic regulatory agenda of countries which are IOSCO members. Sometimes that's more rapidly acted upon in some jurisdictions rather than others. Certainly some jurisdictions in Asia are very compliant IOSCO members and can be expected to act upon it quite rapidly. Hong Kong, Singapore, Australia, Japan, etc. Others take their time because they've got, other pressing domestic regulatory agendas. And I would say that the IOSCO recommendations, as I say, were quite mild. So look, there's a lot going on. As with all areas of ESG regulation, the velocity is increasing across Asia dramatically. I would say watch the space in the European Union and watch the space in the United Kingdom, because the United Kingdom is a very influential exporter of regulation to several jurisdictions in Asia that follow a common law legal framework. And the EU is a net exporter of financial regulation as well, just by virtue of its sheer economic weight. And if you think of GDPR, it's tending to have that effect in the ESG world as well. If you think about the impact of the EU taxonomy and SFDR, A lot of the fund flows come from European investors, or will be, things will be marketed back to European investors. So in that sense, you're operating in the EU, and the EU will be going after you if you breach EU laws. So there's a lot going on, but presently we're starting from quite a low base, I would say.
Got it. No. Thanks for sharing that. I mean, definitely now they always know whom to go to for navigating the APAC regulatory landscape. And Gabriel, any additional thoughts?
For me, just one quick thing to jump in there, really, just to reiterate one of the points made, which is that as an investor, what we're clearly required to follow a lot of the regulation that's coming out of the EU, UK, and other parts of the world. And what we're actually starting to see is increasing pressure across not just funds that are covered by that regulation, but for the idea of harmonization around the way we act as a global firm. And so there's increasing pressure from the investor side towards enhanced disclosure from issuers that we're investing in, so that we can meet our global ambitions around whether it's net zero commitments or other data or other commitments which require significant data disclosure from investee companies. So I think that that idea of the investors that are regulated in Europe as being part of the avenue of pressure onto those in local markets to help in one of those is part of the export, to use Eugène's phrase, which I will definitely steal in the future.
Good. No, thanks for sharing that additional comment. I mean, we talked about ESG ratings. We talked a little bit around the regulations around it. Maybe let's take a look at some of the data challenges underlying the ESG ratings. And Michelle, as a data provider, what do you see as the key challenges that data providers are coming up against when collecting and reporting data specifically across the vast APAC region? I guess there's a lot you could share around it for the audience.
Yeah, no, there absolutely is. And just to start off with, to Eugène's point around the regulation of ESG providers, ourselves and I'm sure other providers out there in the market would really welcome this. So we'll be reviewing the recommendations from the IOSCO output and others, and aligning ourselves and making sure that we are holding ourselves up to our high standard, because we appreciate, and I think as part of the broader financial community, the need to maintain those standards and drive the appropriate kind of ethical and sustainable outcomes is really critical. And we're very conscious, and we talk a lot around concerns that our clients are facing around potential greenwashing. But the other challenge as a provider that we face is we only can report what is published. So there's a huge amount of data to collect and decipher and interpret and normalize, and we need to be able to scale at the rate that the world is shifting in. So in the same way that companies face challenges in publishing the data and keeping on top of the constantly changing landscape, the collection engine is also being constantly reviewed to make sure that we're efficient, and that accuracy of that data is the bedrock of the ES challenges. If investors are able to assess climate risks or opportunities, then they need the climate data that is complete and presented in a way that is comparable and comprehensive across industries and countries, whether that be for investors or for companies listed in capital markets. But there are still a lot of gaps, especially with things like emissions data. At present, we're seeing around, I think, about 60% of companies that we cover reporting on CO2 emissions and saying that they have a policy. Only half of them have a target. So we really need to start expediting that move from voluntary reporting to mandatory, as this will certainly drive change. And as a provider of data, we're constantly wanting to absorb more data so that we can generate more insightful findings. And specific to Asia, we have a much more pronounced challenge with this, as the adaptation of regulation differs hugely, in some cases creating barriers rather than enabling the system. So we have a really fragmented geography. We have a higher volume proportionally of smaller markets who have massive exposure to environmental and societal and governmental challenges that we're trying to collectively solve for. And in Asia, we don't really have a harmonization or a regulatory body as you do in, say, the EU, where you've got multiple geographies and an overarching governing body. So everyone has been historically working at different paces. And we also have a backdrop of vastly different socio-economic demographics. So we've got a mixture of developed and developing countries. Some of the biggest economies reliant on fossil fuel industries and countries facing massive social challenges related to human rights considerations or impacted by the environmental implications of climate change. So supporting the transition to standardizing regulation is part of the challenge that as a region, I think Asia faces in a more pronounced way than perhaps EMEA or the US, and we need to connect the dots a bit more. But I do think that there's real cause to be really optimistic across Asia as a region. We've gone from being a bit of a laggard historically compared to EMEA and US to really turning the tide with increasing adoption rates and regulatory pushes. So going back 5 years, you only had a very small number of countries really adopting ESG in anger, and you had the likes of China, India, South Korea, so massive global economies scoring really low in their adoption rate and their ESG results and outputs. So you now have China, Singapore, Japan with the FSA setting expectations, pushing for reporting and regulations to be at a much higher standard and much more aggressive in their timeline. So it's really exciting to witness that we're starting to move the needle on a reporting and disclosure perspective and get Asia well and truly on the global map.
Got it. No, Michelle, thanks for that. That's very positive news. And I think that also resonates with the IOSCO report, where one of the findings was around the uneven coverage of certain industries and geographies, especially here in Asia. Yeah. So thanks for sharing that. Gabriel, I recall you mentioned also early on separately on bias, and I understand there is a large cap bias as well. Can you share what kind of data availability biases and issues you're seeing in the industry as well?
Yeah, sure. Thanks. I think that when we think about bias or skews within ESG scores, one of the most common that across different data providers is a tendency for larger companies to have higher ratings. And this can be explained through one angle, which is that larger companies may have larger budgets to spend on ESG topics, so could potentially have a longer list of policies or CSR reports or other sorts of mitigation initiatives and strategies that they're willing to announce and disclose to the market, or hire external consultation in order to refine their own policies in a way that will enhance their score. There's a fantastic correlation between company size and length of CSR report as well, where if you look at company market capitalization and the pages in the CSR report, it's almost a perfect straight line. So I think that this leads towards a question around ESG score design and rewarding companies for disclosure of a lot of these topics, as opposed to the underlying metrics that you can use to measure performance. And this comes back to Michelle's comment around data availability and the types of gaps that we actually face. And so often it would be fantastic to be able to use a company's raw data to assess their performance and to have a hard performance-based metric, but often we don't, which means we have to fall back on a proxy for that performance, which is often a policy or a framework. And that can potentially distort the outcome a little bit. A relationship between companies where if you do have a policy on something or a target, you do tend to be more focused on that metric as a general rule and tend to work towards addressing the underlying issue. So it can be a signal for engagement, but it's critical to be able to cut through to the underlying data to really be able to assess performance in my personal view. Some of the other interesting areas around bias can actually be through country regulation and the way that it can influence disclosure or standards. And a great example here is actually the level of independence on boards across the region in Asia Pacific. And I think everyone would generally agree that having independent directors on a board is a good thing as a minority shareholder. However, if we look at different markets, what we find is that the minimum regulatory requirement literally sets within a few percentage points where the average is going to be for that market. So we see that in countries like China, the average number of independent directors on a board is almost bang on 33% with the regulatory minimum. In South Korea, it's almost bang on 50%. And this can lead to a question of, are you genuinely believing that having independent directors on the board is an important thing, which is part of your operation of the company? Or are you ticking a box from a regulatory perspective, and the strength of the independence of those individuals could potentially be questioned? And so these are some of the problems where a regulatory framework can lead to the need for further analysis if requirements are made mandatory to actually cut through to where it represents genuine integration within and engagement with the underlying topic versus a tick box or boilerplate response to a new regulation.
Got it. No, thanks for sharing the large cap bias and the importance of having independent director. Maybe one more question on the data challenges. I mean, Michelle, I mean, we also have the dimensional public versus private companies in terms of the amount of data that they. How do you deal with that as a data provider?
So it's really interesting, and I was chuckling along there as Gabriel was mentioning that, because it's a challenge that we talk a lot around. So when you have bigger large cap companies who potentially have more resources to put together their reporting requirements, we also look to include things that will hopefully balance that out, so that we acknowledge that. So there's kind of weightings and expectations that are built into the models that hopefully account for that differentiation between the size of the companies. And we also look to, I don't want to use the term, but penalize companies where we would expect there to be reporting and there isn't. So there's some interesting angles that we and logic that we apply within the modeling to hopefully manage for that. But the challenge around public information and public companies versus private is one that is a really difficult one to solve for. We know that there's a huge focus on the private sector and the reliance of finance within that part of the markets, and we need to be aware of the ESG performance across the private sector, and they're increasingly coming under pressure to disclose more data relating to their performance against ESG issues. And from an impact perspective, I think private companies are typically smaller, leaner, there's less red tape to navigate, so they can be a bit more nimble in how they operate and innovate versus their larger public company counterparts. So initiatives around sustainability will be enabled faster, arguably, in private companies. So we're really keen to explore that a bit more and to be able to publicize information around that more. But it's much harder to gather that information and present it across a platform when it's just not being forced in terms of the publication rate. So I think it's a challenge that as an industry we do need to solve for. We tend to, and most providers out there tend to cover publicly listed entities. We are now looking at ways that we can capture the private sector as well by enabling them to provide their scores and contribute their scores to us. So we've built capabilities to allow for that, but there's certainly still a long way we need to go on that journey.
Oh, perfect. At least we're moving in the right direction. So thanks for sharing that. Let's now move more from the data providers more and the regulation to the user's perspective. I mean, Eugène, I know you work a lot with banks across APAC with regards to the use of ESG ratings and data. What do you see as the key issues that they are grappling with for the banks?
Yeah, I think the banking industry is somewhat behind the asset management industry, because I think the asset management industry was a first mover in the field of sort of understanding their ESG data needs and their rating agency uses. Banks are really being directed to both by their sort of public perception and their need to address that, and also by their own financial imperatives, particularly climate change as a financial risk. And thirdly, by regulation to start addressing these things. Now, I think they have the benefit of resources in many instances over all except the largest asset management companies. But equally, they face, much greater diversity and complexity in their business models. And, the largest banks, if you think of several headquartered in Asia that have massive, emerging market exposures, the variety of geographies that they're exposed to and how ESG factors manifest in each of them is vast. So to start off with the first thing, just assessing their data needs and, what data will satisfy those needs and, what other external analytical needs they have is a critical thing. And so that's a task that they're undertaking at the moment. Some are more advanced than others. But as you mentioned earlier, the paucity of data in APAC is a really big problem for them, frankly. particularly in the, unlisted company arena, because, banks are lending to SMEs. Trade finance is a huge source of emissions as well. So, these things are of critical importance to them. The second thing is they're trying to bring their data needs together, because the data needs of a bank are more complicated as well. Again, it depends on their business model. But if you're an integrated universal bank that does retail banking, commercial banking, institutional banking, investment banking, asset management, insurance, dearie me, what data do you have? Where is it kept? What is its quality? What uses is it going to be made for internally, externally, regulatory reporting, external TCFD reporting? Are you using the same data for the same purposes, or are you using different data obtained from different sources by different business units? So building data utilities for the biggest banks is really quite critical to have a proper data governance structure there. So that's really important. We're seeing banks start to engage in that activity and think about it quite seriously. And then I think it's turning it into actionable, decisionable information. ESG information is incredibly complicated. How do you turn that into the right KRIs, key risk indicators, KPIs, which I presume I don't have to define for everybody, and, the management information, so that the board and senior business leaders, risk leaders, compliance officers even, can make the right decisions. So I think they're the three key focuses at the moment. There's a lot to do, and it's very challenging, to be honest.
Thanks for sharing that, Eugène. I mean, I guess those are challenges similar for insurers and listcos as well. I mean, maybe in our last 3 minutes, looking ahead, what do we recommend for the future to build better and more useful ratings? Maybe I'll start with Gabriel.
I think that there's a lot of different things to that question, and part of it's building on Eugène's comments around the actual need for the right systems and infrastructure to actually support it. And I think what's increasingly going to happen, at least on the asset manager side, is a move towards using a lot of different data providers for the underlying tools and building blocks, with very broad data providers as well as incredibly niche emerging data providers for specific use cases, whether this is satellite mapping for physical climate risk or other sorts of areas, or looking at other sentiment scraping information providers and other sorts of things like that. So I think that there will continue to be the need for a wide range of data providers. Onboarding and harmonizing and integrating all of that data is an incredibly challenging exercise. I was chuckling away when Eugène was talking about the complexity of systems. I feel like the IT system and compliance team are growing, the only team that's growing as rapidly as sustainability teams across asset managers in the region. And so there's been a huge amount of headcount and capability building that's been required to actually deliver these scores. So from my side, I think the complexity of the IT solutions combined with standardization of the foundational building blocks and data inputs, as well as capabilities, training, and the actual use of that data, and to make sure that it's integrated in part of fundamental decision-making and not seen as a siloed tool. For me, that's what's really quite required from an asset management side to have very, very impactful ESG information and ratings.
I get it. Also, Michelle, any?
Yeah, no, I would 100% support Gabriel's comments. I completely agree. Even as aligned to one data provider, I think you certainly need to be looking at where your particular investment strategies sit and who is best placed to support your requirements. The other thing that I think just more across the industry, and we're seeing it more, is we need to move away from voluntary reporting. And even the comply or explain mantra, I think, is still too loose. I think we need to be forcing and mandating exposure of information, because we're never going to expedite the change unless we do that alongside the regulatory drive.
Perfect. Eugène, any final thoughts?
All of the above, plus regulate ESG data providers and rating agencies, I think, frankly.
No, get it. Perfect. No, really thanks for taking time for the panel and for the audience as well. If you want to read more, IOSCO published a report 2 days ago called ESG Ratings and Data Products Providers. And if you need anything, just reach out to each of one of us individually. And with that, I'm closing the panel and introducing the next panel, which is the fireside chat, the future of ESG technology and data, which will be moderated by Nick Wakefield, co-founder of Regulation Asia and ESG investor. Thanks everyone.